Market reverses last week, gains to fall 1%, except for IT and PSU banks. All sectoral indices end in the red for this week. Hello and welcome to a new edition of Editors Roundtable. We take stock of the market action. We tell you why FPIs continue to remain big sellers in the month of October. We'll go through the big EPS earnings upgrades and downgrades so far. We'll put the spotlight on the tech sector's outperformance, and we'll decode trend and page industry second quarter numbers. Action-packed show. I'm Reema Tendulkar. With me, Prashant Nigel Mangalam. Hi guys, and joining us on the show, we've got a special guest, Shiv Puri, founder and MD of TVF Capital Advisors. Hi.
We're going to rain all questions to Shiv there, because he's the FI who's been selling. I think, Shiv, coming to you, but I think it's been a tiring week, Friday fatigue.
How can you start every editor's roundtable by saying exhausted?
I'm pumped up.
Yeah, I'm looking forward to the weekend. You know why? Because the next week is a truncated one. We have a long weekend. The one after that, Exchange has just told us that it's a responsible truncated week. You have to go vote. And at least for all of us here in Maharashtra, November 20th, so stock markets are shut.
So it's so voting on the 20th, right?
Voting is on the 20th.
So it's not a Friday or a Monday.
It's not a Friday. That's right. In case you're planning to, take one of those sandwich holidays, then 15, 16, 17, 18, 19, 20.
Not for voting.
Not for voting. Never for voting.
Right?
Well, that was the other cue, right, that we were watching. That's going to be the Maharashtra state elections, and we'll wait by for the outcome. But today, this week, we had two big cues that played out. Donald Trump is back at the White House, and in fact, he's back the U.S. presidency. And on expected lines, the Fed went ahead and they cut the rates by around 25 basis points. The problem is the FIs, they continue to sell in the cash market, and they're net short in the index futures. But there's no signs of them covering those shorts, at least as of now. So we'll require a fresh trigger on that front. In terms of a market range, 23,800 to around 26,000, 24,600 appears to be that range, at 800-point range. We almost went to the 23,800 mark twice, and we bounced off that. The problem is the FIs, guys. They have betrayed us. I mean, they just... the last month, they sold close to $11 billion. That's even more than what they sold in the COVID month. The COVID month, it was around $8 billion or thereabouts. That was in March 2020. And who's offset all this FI selling? Well, you, the DIs. Indirectly, you have played a role out there, because the DIs have pumped in close to around $12 billion. But what is this FPI selling? Is it just India? It is other nations as well. Like Korea saw outflow of close to around $3.5 billion approximately. You had Thailand that did see some bit of selling, and Taiwan was the lone market that saw inflows from the FPIs. But otherwise, India's selling was much more than all these other countries. The major outflows that we saw were the financial and services, obviously because they have the largest holding out there, oil and gas and consumables, as well as FMCG. While there were mild inflows coming into metals, chemicals, as well as utilities. So it appears there's an element of that China rebound as well that's playing out, going by the flows in metals as well as chemicals.
Welcome to the show. First time on Editors Roundtable. So let me put that to you. Why all the selling?
Well, thanks for the warm welcome with that word. But, frankly, I think it's quite puzzling even for me, because I think some of it seems backward-looking, and some of it seems very short-sighted. Backward-looking because, when I talk to some big FIIs, they will make the argument that, look, the S&P 500 has done really well in dollar terms, why bother? Looking at EM. And I think what they miss there is that India should not actually be EM, not because it's not emerging, but because the fundamentals of the economy are completely different than most, if not all, other EM markets that it gets grouped into. And frankly, the performance of the index in dollar terms is very comparable to the S&P, and better than the S&P in dollar terms if you exclude the big 7 tech companies. So I find that argument that, why bother, to be a little bit backward looking. I think the short-term view, which is why I think you see this big number in October, other than just simply looking at, price to earnings ratio in China being so much lower, and therefore saying we're going to reallocate without understanding the structural issues that still exist there, is a real fact that near-term earnings are really slowing down in India. And the last 2 quarters, the slowdown has been quite steep. I'm surprised more people are not focused on it. I think I was on your show right after the budget, and I was a bit surprised that the budget focused so much on fiscal deficit, but not enough on spending. I think you're seeing some of that in terms of the slowing earnings growth that is really coming across across the sector.
So there are 2 points to what you're saying. One, you said that you are confused, so we're wondering whether you are selling or buying. And the second part, you said that when you speak to the big FII, so again, we're wondering whether you're not the big FII itself. But on both those points, we'll come back to you. But the third point that you made on earnings itself, that being disappointing. Well, Prashant's done some data crunching. Prashant, it's a season to forget.
It's a season to forget, right? And I hope we can forget it. And, starting the next earnings season, we get better tidings. But let me go across to the wall and explain essentially what has happened, right? And this is the second quarter earnings season that we're looking at. And to the Chiv's point that some of this is backward-looking data, so be sure this is backward-looking. This is not third quarter, October to December. This is not forward-looking. But this is, it does matter because what we're doing is we're looking at how earnings estimates for NSE 200 companies, the most liquid companies in the market, have moved for FY25 based on Q2 beats and misses. How full year estimates for these 200 companies really worked out. So the group set is this. 143 companies have reported so far. 10 out of these 143 companies have no earnings estimates available. Let's just go back to the first plate, please. 10 have no earnings estimates available. So the data set is 133 companies. Out of 133 companies, 66% of these companies have seen EPS downgrades. I don't remember the last time we had such high percentage of companies seeing downgrades. 27% companies have seen EPS upgrades, and 7% companies have seen no changes to their EPS estimates at all. So let's quickly now work down to individual stocks and which are these companies which have seen the maximum downgrades. And I've sort of kind of largely tried to group these along sector lines. Look at the steel companies, JSW Steel, Tata Steel, JSPL. This is earnings estimates for the full year FY25 and how they've moved since the earnings season started, and the earnings season is 4 weeks old. So this is, this is the set. So steel, look at the next plate, please. IOC, HP, BP, anything between 8 and 25%. Let's move along to power companies, right? Adani Green, JSW Energy, BHEL. Look at the downgrades here, 17 to 20%. Look at cement, 13%, 11%, Ambuja, 7.5%, 8%. You look at some of these new age companies, Zomato, 15% sort of downtick to full year numbers. SBI Cards, IndusInd Bank are some of the others. Indigo has seen a 19% pull down to their full year estimates. SRF, APL Apollo. Then there's an assortment of other companies. Biocon, I was surprised. I'm not sure what happened here. But these are Bloomberg consensus numbers. Tata Communications, PV Fintech, Supreme Industries. DMart has seen a 10% downgrade to full year numbers. And there's Container Corporation as well. So, and of course, on the flip side, this is the set. I mean, it's a short list here. But GMR 9%, Hoodco, PNB, Indus Tower, Dixon, Oberoi Realty, and Bharti Airtel. So that's what we've had. Shiv, you said, that earnings have come off, and this, of course, is a pretty sad picture out there, and maybe things will improve in H2. Government spending will pick up, as many have pointed out. But do you think we're at that point where there has to be some fiscal help or monetary help? It doesn't look like we'll get any rate cuts anytime in the future, but what's your sense?
I think, the data that you've just shared and what we see out here increasingly shows that this is a slope that's moving downward. And it's not automatically going to just move in the other direction. It's quite clear monetary policy is very tight. And you've seen the Fed cut rates by 75 basis points, 50 last time, 25 yesterday. In India, the rates haven't moved at all to the downside. So monetary policy is tight. Fiscal policy seems tight. And earnings growth is slowing down materially. So I think without some of those levers moving, it's hard to see how this would change in the near future. And just coming back to, the earlier comment on FIIs, I just want to clarify. I think the FIIs that you'd find would be selling would still be those in the category of, looking at sort of trading in and out of markets rather than those that have a multi-decadal view or a multi-year view. Because clearly in markets valued the way they are, where you can see the Nifty trading at low 20s times earnings, or mid-20 time earnings. Slowing earnings this rapidly, the way you just showed on the screen, will obviously cause people to sell if they're being purely rational.
Right, Prashant, you spoke about the entire earnings sector, earnings performance for the market at large. I'm looking at the consumer space, and there were two that really confounded me because both of them saw decent growth in terms of performance. The stock price moves were very divergent, and this happened in the last couple of days of the week. I'm talking about Trent and Page Industries. So let's talk about that, tale of two cities. So if you look at the post-earnings performance, 2 days post-earnings, Page Industries was up around 9%, whereas Trent was down 8%. Was there any problem in the earnings for this kind of move, or was there any positive surprise? Well, for Trent, the revenues grew 39%, EBITDA grew by 41%, and you had margin expansion. The net profit grew by 47%. For Page Industries as well, 11% revenue growth, 30% EPS growth. So what exactly happened for these stock prices to move in these divergent ways? Well, there are three reasons. One, the stock price move in ahead of these numbers, expectations of what the street had, and the market mood. Let's talk about the stock price move itself. Preceding 6 months before the earnings, Page Industries was up just 28%, whereas Trent was up double of that, 56%. The last 12 months, Page Industries has actually been an underperformer, up just 17%, whereas Trent is up 183%. So stock price move was one of the factors. The second, performance versus expectations. So this is Bloomberg expectations, and this is CNBC-TV18 poll. For Page Industries, the result versus expectations was up by about 19% on the revenue, 18% on the net profit. For Trent, it was down 3% on the revenue and down 22% on the net profit as compared to expectations, despite growing 47% on the bottom line itself. And they were below their own 5-quarter average for Trent as well. The last 5 quarters, on an average, the revenue has grown 51%. This time around, due to muted consumer sentiment and perhaps a high base as well, grew just around 39%. For Page Industries, the last 5-quarter average was a decline of 2%. So in that regard, an 11% growth seems like a far outperformance itself. The third most important, market mood. In October, just a month ago, Trent was up 10% between October 7th and October 9th. When the company announced a lab-grown diamond collection itself. Come to 1 month later, an EPS growth of 47% between November 7 and November 9 takes the stock price down by about 8%. Mild miss on elevated expectations. So that's telling you the divergence in the market mood itself. The big question, where are the valuations now? For Page Industries, 67 times 2-year forward earnings, Trent 95 times 2-year forward earnings. Both of them not particularly cheap, but it's important to put the PE along with the growth as well. The expected EPS CAGR for Page Industries over the next couple of years is 19%, and for Trent it is 55%. So if you look at it on a price to growth or the PEG ratio, Page Industries is 3.5 times. We have Trent at 1.7 times as well. Let's talk about the triggers for both and the risks. For Page Industries, the big triggers would be how they grow in e-commerce, Tier 2 and Tier 3 expansion, women's wear and athleisure are the couple of growth triggers for them. For Trent, it's an expansion of Zudio footprint, growth in the star format, seeding new platforms, and perhaps some growth in lab-grown as well. For both of them, common risks, competition and consumer sentiment. So we'll watch out the trail of two cities, two stocks. Divergent numbers, divergent stock price moves, but similar expectations and similar risks. In fact, let's go across to Shiv. Shiv, you own Trent in your portfolio. What did you make of these numbers, and what exactly are you doing?
Well, again, without commenting on what's in the portfolio or anything specific, I think with the company that you mentioned, Trent, and again, this is no investment advice or anything of that sort, it is really important to keep in mind these numbers that they put in the context of weakening consumer spend. So this is a retailer that has grown at 40+% in terms of top line, and a consolidated numbers of earnings is up 50%. In an environment where you see most consumer companies struggling to grow mid-single digits or high single digits. So these are the two, I think that's important to keep that context in terms of how they did when the overall environment was a little bit weak.
Okay, Shiv, hold that thought. We will slip into a very short break. We'll come back, continue our conversation. We'll also get your view in on the technology sector. Well, that was the only marquee outperformer this week.